world is changing fast. New technologies are impacting how we think about products, services, and the way we live our lives. Nowhere is this trend more present than in financial services, where new business models and customer expectations are changing our conceptions about banking, finance, and the very nature of money. Welcome to Rebank, a visionary podcast about banking, fintech, and the future. The future of banking is here. Hello and welcome to Rebank. I'm your host, Will Beeson. Jon Stein is the founder and CEO of Betterment, one of the world's leading digital investments companies. We first connected with Jon in January of 2018, in a great episode that's still very relevant today. Since then, Betterment has added $4 billion in assets under management to its platform, and today, they're launching checking and savings accounts as they extend their offering into banking. This move is a compelling one, at a time when consumer fintechs are increasingly extending early product sets in pursuit of comprehensive financial services offerings. In addition to the insights we deliver through our podcast and newsletter, Rebank offers advisory services to fintechs, banks, and corporates. Drawing on our experience starting, running, and advising fintech businesses, and our vast network of the most impactful fintech entrepreneurs, investors, and innovators around the world, we help companies make sense of fintech, work through specific questions, and optimize proposition and strategy. For more information about our services, please visit bankingthefuture.com. Thank you very much for joining us today. Please welcome Jon Stein. Jon Stein, welcome to Rebank.
Well, it's great to be here with you.
Yeah, well, I appreciate you making the time. It's great to connect again. It's been, I think, over a year since we last connected on the air. We've caught up a few times personally since then. It'd be great to just get a bit of an update on what's been happening with Betterment since we last spoke.
So in the last year or so since we spoke, we have added an additional $4 billion in assets to the platform. We've grown from $14 billion to $18 billion. We've added about 100,000 new customers using Betterment. And we have built out our tools around cash management. We added a Smart Saver account in the fall. We added a two-way sweep to that to automatically transfer money from your checking account and so on. More personalization, an enhanced mobile app. And now we are really excited. Our major focus for the year, we are launching Betterment every day.
So that is super exciting. Firstly, congrats. That's amazing progress in just the short time since we last connected. So tell us about the new proposition. What's that?
Betterment Every Day is our move into your everyday cash management. We started Betterment 9 years ago to help our customers make the most of their money. And we mastered your long-term money. We mastered the what should I do with my retirement savings, and have what is the best in market solution for people who are looking to save for the long term. I like to remind people that we earn the average customer who's with Betterment 1.5% more per year, which translates into 40% more cash in retirement than if you were to just buy and sell mutual funds or ETFs on your own. So tremendous value creation for our customers. And as we talked to customers, we realized one of the challenges, particularly for the demographic who we attract, whose average age is 36, who are relatively early in their savings journey, is how do I save more? How do I make the most of my money today and tomorrow? How do I make most of my everyday money? And we've been working for some time on this concept of helping our customers make the most of their everyday. And so today, we are launching the highest yielding savings account in the market, coupled with a truly fee-free checking account, global ATM fees reimbursed, no overdraft fees, no nuisance fees, no account maintenance fees or minimums. So really a best in market, like the solution to beat them all, checking and savings accounts.
Okay, so I love this on so many levels, and hopefully we can work our way through all of them as we go. I think first and foremost, and this is, I mean, it feels to me like it's been the core issue with personal financial well-being for years, if not decades. Like you kind of have your day-to-day banking sitting in one place, and it's probably with one provider, and you're kind of looking to optimize some decision making around that, specifically around savings, and then you're, I don't know, maybe transferring some of that to another account where all your investments sits, and that's a separate bucket mentally, and it's a separate provider, and it's just a separate segment of that kind of comprehensive personal financial management piece. And the lack of tie-in where it seems like there should be one, and it seems like the benefits of there being one would be so great, has been something of a head scratcher for so long. The ability to provide someone with day-to-day banking plus the savings piece plus the investments piece, and to some degree the kind of insights, overview, analytics that goes along with that, at least in my view, unlocks the ability to start to actively help people move themselves in the right direction when it comes to solving the massive problem of kind of long-term retirement savings.
I agree completely. When I started Betterment, I thought at one time we might be a bank. I thought about a lot of different models. I thought, should we be an advisor? Should we be a broker? Should we be a bank? What's the best way to approach our customers? I knew that someday we wanted to answer these questions about everyday money movement, to build that self-driving wallet to help people make the most of today and tomorrow money. And we chose the investment advisor structure because it aligned us best with customers. It allowed us to build the most efficient model to serve them and to be that advisor that chooses the best products from among everything in the market. So on the investing side, we built our reputation on being independent and being able to choose you the very best ETFs, the lowest cost, the most diversified, the most liquid. No matter who the provider, we don't care. We're going to get our customers the best. And now we can bring that same level of fiduciary representation of our clients to banking, where we choose the very best banks to give you the best rate on your money. And it's not just one partner bank. We're able to choose among the best. And so that allows us to provide our customers with $1 million of FDIC insurance, not just 250K, and to provide the very best rates from all the banks in the country. And I love the power of that platform and this position. I think it puts us in a great competitive position to provide the most customer-centric money management in the market.
Yeah. So I want to come back to the point about the platform and get into how you're doing all this. But before we do, I think there's more to dig into here. So the question I would have is to what extent at launch or as part of longer term plans do you expect kind of meaningful data feedback between the everyday banking piece and the long-term investments piece? I.e., is this an on-ramp to get people investing more and better? Is it an on-ramp into more regular day-to-day engagement?
All of the above. When we began concepting this, one of the observations was that for many people, for many of our customers, retirement is a long way off. Wow, 40% more cash in retirement sounds amazing. Who wouldn't want that? But a lot of people who are maybe in their 30s are just thinking about putting a down payment on a house, or they're thinking about how do I start to save a little bit more than I was last year? Saving just $1,000 this year would be great. And to get those people engaged, rather than talking about retirement, we wanted to talk about, here's the best rate in market. Here's a thing that you can have today. It's clear, it's compelling, it's simple. There's no annoying fees. There's no minimum. All of our same values of Betterment we can bring to bear on this, but we can meet people where they are and help them make the most of those everyday savings. And of course, yes, build that into, wow, you've saved $5,000. Maybe it's time to open an IRA. Wow, maybe it's time to start thinking about investing a portion of this balance. There's a waterfall, if you will, of needs. And that initial savings account we can push into longer term goals. I should point out, there's not just one customer type in our base. It's not as though everyone is there. We also have many super sophisticated founders of billion-dollar companies who have hundreds of thousands of dollars sitting in cash. And some people just want to hold on to FDIC insured cash. And so bringing the best savings and checking accounts to market helps not only that early start out customer, but it also helps our existing customer base of really sophisticated savers and investors.
If you had to guess, and maybe you have an internal view already, do you expect this to be more of a hook in attracting new customers, or more of an opportunity to deepen relationships with existing customers, say in the first year?
It will be both. I think if we don't see new to Betterment customers adopting these accounts, then it won't be as successful as we would hope. Obviously, we hope to continue to reach more and more people, and having these cash options is a great way of reaching them.
Mm-hmm. Do you expect there may be users of the product who don't invest with Betterment, or at least initially, i.e. that just look to use it for their day-to-day banking?
I'm sure some customers will use us that way. And that presents a really interesting design challenge. There's all these companies out there who are, you've documented on your podcast multiple times, how many people are kind of running to the middle of trying to be, wealth management and lender and banking and all of these things. We're not doing all of that today, right? We are saying where we think we can make the most impact is with your everyday savings, your today money, and bridging that into your tomorrow money, your future retirement savings. Making that experience really the best in market is our focus. And so learning how to coach people about when they have enough savings and how they can save more and how to make the most interest on that savings, that's where our focus and attention is going.
Do you expect that over time, Betterment rolls out other banking and or FS products that kind of fall outside the traditional scope of investments, or is this kind of a one-off product launch?
We, on our long-term roadmap, continue to have things like mortgages and life insurance and all the products that our customers want from their lives. I've always talked about those as part of the long-term roadmap of Betterment, but they're not on the 2019 roadmap. As we think about going into those markets, I like to say we don't have to manufacture everything, right? We don't have to make our own mortgages or make our own insurance. Just like we don't manufacture our own ETFs. One of the things that makes us great is we're able to choose the very best in market. And here we're bringing that same independence, objectivity, and customer centricity to banking.
So this may be a great segue into the way you're actually partnering to deliver the proposition. I assume you're partnering. So you mentioned being able to source highest in market interest paying savings accounts from up to, I guess, four different, i.e. FDIC cover from up to four different banks. What's the structure kind of behind the curtain?
We are able to spread our customers' FDIC insured cash across multiple banks. And the number of banks today might be 7. In the future, it might be 20. It depends on the scale of the program. But we're able to find the banks that are offering the best rates in market and negotiate those rates on behalf of our customers, and then create accounts on behalf of our customers with them in these FDIC insured vehicles. We can pass all of that rate back to our customers because we think about this product as something of a freemium product, if you will, right? We're able to just offer the best rate in market because we're not just offering a savings account. We're offering this full suite of advice and money management that customers love. And if we think about this as a way to introduce customers to Betterment, I'm sure that many of them who manage their cash here are also going to want to manage their investments with us and have a checking account with us and so on.
I'm familiar with a few leading providers in kind of platform banking space in the US, the Bancorps, the Cross Rivers, the Synapses of the world. Are you using one of those partners?
We're working with a bank called NBKC. They are the bank of record for our Visa debit card and the checking accounts. And then we're working with a whole bunch of partner banks on the back end to manage the savings.
Because I have very recently been actively involved in engaging a partner bank for a US-based project, without naming names necessarily. I mean, what was it about the particular partner bank that made them most relevant to you based on what you were trying to do?
Well, part of me liked the idea of empowering community banks throughout the country, because I think you've talked about this a bit with some people on your show. There's a bit of a concentration in this country of power amidst the top 4 or 5 largest banks who are opening all the accounts, and the sort of American, maybe the Texan in me, wants to have a little bit more diversified ownership and a more federal banking system. So I like supporting smaller banks. One of the reasons that we chose NBKC was they understood our mission. They've been fast growing. They're really working hard to do what's right for their customers. They were aligned with our values. They were a tech forward option, and they have a national footprint. They have a national mortgage origination business, which gives them, great tech and access, sort of nationally. So there were good things that made them a natural partner for us.
If we take a step back from this specific product launch, and even from Betterment specifically, how important is the development of the platform banking infrastructure in the U.S. right now to the future of consumer fintech, in your view?
I think it's quite important. We are launching these services now because of this platform banking infrastructure. Years ago, I thought about it back when Simple was launching, and I thought that was an interesting model. But the ability to customize and build a truly customer-centric experience didn't seem to be there yet. And I think Simple did a tremendous job. But there were limitations to the flexibility of that. And today, I believe we can build what is really a Betterment experience, the kind of quality that Betterment customers demand from us is possible thanks to some of the platforms that are out there. And it's not, of course, the big banks that are making this available, because it's competition for them. But there's a number, as you mentioned, there's a number of firms making banking services more accessible. And I think that's great for consumers.
I'm interested personally in this this kind of rush toward high yield savings accounts as an angle to grow customer bases. Varo, T-Mobile, Wealthfront, Robinhood, and a number of others are kind of leading with a high yield savings account as a hook for new customers. What is it about that headline number that is expected to really drive customer adoption? I assume it plays out in practice. Otherwise, I doubt so many people would be doing it. The skeptic in me would say, okay, those are rate chasing customers who come for that number, and then once you either reduce it because you don't need to bring on new customers at the same rate as you did before, or someone else offers a better rate, then they leave. What's the expected dynamic there?
One of the great things about a savings rate is that it is easy to understand. I can tell you that we earn the average customer 1.5% more per year on their investments. And to explain that, I have a 20-page white paper with various scenario analyses that show distributions of expected returns over time in all different tax scenarios and lifespans. And it's all great research, but it takes a PhD to read through that and understand it. A savings rate is dead simple. And I can tell you 2.4 is better than 2. And I can tell you 2 is better than 1.5. And anyone can grasp that. And I think that ease of communication is one of the reasons why you see people gravitating to this as a hook. And we believe that provides us, first, it's mission aligned with us and very much aligned with everything else we do to give our customers the best returns on their money, net of costs, net of fees, net of taxes, all of these kinds of things. And it allows us to build a relationship where we can explain just how all these, more sophisticated strategies work that we make available to customers.
And that's what, a 2+% headline rate, right?
Our rate, as we look at it today, is 2.69%. However, these rates fluctuate with the Fed Reserve, just like any savings rate fluctuates with national interest rates in this country. So we have the market leading rate as you and I are talking today. And I believe structurally we've built it so that we can always have the leading market rate. However, all of these rates will be subject to future moves.
Are you subsidizing that rate at all, or is that actually the rate that the underlying bank is paying?
That rate is the actual rate that we are getting from the market. It is what the most aggressive banks are willing to pay for savings deposits. And there may be companies out there that are subsidizing that, but no one is doing it for, say, all customer deposits. We are offering this rate no matter how little or how much you have with us, which I think is unique. Sometimes you see banks offering teaser rates for a limited time or only up to $1,000. And then over that, the rate drops on your entire balance. Those kinds of gimmicks don't play well with our customer base who demands the best on all of their money.
You mentioned that a checking account is part of the offering. That product, I think, has been a boon for a lot of consumer fintechs as a result of the Dodd-Frank related legislation, according to which banks under $25 billion in assets can charge uncapped interchange. And it's been a nice way of some banks, and Ryan King from Chime went into this dynamic in detail. It's been a nice way for some banks to be able to offer free services. Is interchange likely to be an important driver of the virtuous cycle of the way these products interact with each other for you?
Interchange fees, which we would earn anytime someone swipes their card, and we would share, of course, with Visa, the network, and the merchant provider, who's the bank of the merchant where you're swiping your card. Those fees are one of the ways that we'll make money on our checking account. However, we won't be charging any monthly maintenance fees, overdraft fees. We're going to reimburse people for ATM fees at any network, at any ATM globally. And there's no minimum balance. So all of these things, we believe, help us bring to market the most customer aligned checking account because we're not nickel and diming you. There's no annoyance fees in that account.
Love it. If we again kind of step back and think about the broader market, it's it's not news to anyone who's a regular listener of this podcast, or frankly anyone who follows the fintech space closely, that there's something of a convergence across a whole range of single vertical consumer fintech companies to comprehensive consumer fintech offerings. I'd be interested in your view as to how this. So obviously the new product set brings you guys a step closer to a more comprehensive offering. It aligns you to an extent with some of the other leading U.S. consumer fintech brands. I'd be interested in your kind of high level views as to how you're continuing to see this dynamic unfold, starting as an investments company as opposed to a checking account and debit card company, as opposed to a stock trading app, for instance. How well do you feel like Betterment at this point in time is positioned vis-a-vis some of your peers in the industry?
I love our position for our target customer, which is a striver, somebody who's trying to make the most of their money, oftentimes a professional, a banker, a lawyer, a doctor, a teacher in the military, somebody who really is saving and earning well. And Our customers tend to be, good credits. They tend to be saving and investing. They tend to be smart about their money management, and they just want to do what's best with it. There's a lot of other propositions out there for different customers. I have a lot of respect for the folks who are attacking, say, the underbanked market or the subprime market. Those are difficult challenges in their own, in different customer bases. And maybe I don't have the level of confidence to go into those markets, right? I think there's a lot of unknowns in terms of how you make money. It doesn't feel great to me to be charging monthly fees, say, to people without a lot of money. It doesn't feel great to me to be offering more lending products to people without a lot of money. I believe we ought to be, as a society, saving more and encouraging smarter spending decisions, leading to more happiness. Our mission is to help make Americans happier, not to give them more credit, not to give them more things, but to help them live better lives. And I believe that for our customers, we are best positioned to help them be happy and live the best life by making the most of their money.
What effect? I'm sure you guys have modeled this to some extent internally. What effect do you expect the checking and savings products to have on the kind of underlying unit economics or financial viability of Betterment? I feel like we talked last time about what your view then of break-even AUM looked like. How do these products impact those considerations?
There's no question but that this is an interesting addition to our suite of products. We expect our banking offerings to be variable profit positive almost immediately within year one. And of course, we have a lot of assumptions baked into that as any fast growing company, innovating and trying new things does. I think the interesting thing about particularly the checking offering is that everyone who uses it, you don't have to have a lot of money to use a debit card. And so it almost equalizes things. Today, we charge 25 basis points on assets, which means smaller accounts are harder for us to, say, earn money on if we have, say, customer service costs that, do scale with assets, but maybe not quite as fast as assets. And so as I think about the debit card offering, I think about that as almost a floor, right, in terms of revenue that allows us to better serve those customers without a lot of money and continue to provide, best-in-class service to those customers who have a lot of assets with us.
How this question may not immediately seem to link back to that question of underlying unit economics, but I think it does. So how well do you think the industry is currently positioned vis-a-vis in any potential, macroeconomic slowdown or God forbid, slowdown in venture funding? Like to what extent do you think is the consumer fintech space, let's talk about the US specifically, market best, to what extent are companies kind of leaning over their skis, paying for customer acquisition, raising rounds, paying for customer acquisition to hit scale, which will support positive unit economics versus building, financially viable businesses that, in the event of global economic weakness, would be sustainable enough to see them through to the other side?
I can only share my perspective on that. And I'm not, I've learned a lot from my fellow fintech founders about other areas in the business where they found opportunities. And I just think I think there's an incredible diversity of different models and different target customers and people monetizing in different ways. I'm learning every day. I mean, I have dinners with other founders, and understanding the economics of all the different parts is great. I started where I did on the investing side, helping people make the most of their long-term money, because from my days as a consultant, I saw that was the business that you want to start and keep over the long term. I think there are many cycles of lending businesses getting big really fast at just giving away money, and then running into trouble in a credit cycle. There are fewer examples of checking or banking companies getting big in the last few cycles. It's been a hard thing to do. I think that's an interesting area where maybe innovation is more possible now than it has been in the past. And so we'll see. But it's particularly hard to say make money off of low balance checking accounts or the underbanked checking accounts. I think that's a tricky spot. But there's really amazing people now working on that problem. I chose our spot because I like it as the business you keep. And if you look at the companies that have been around for 100 years, in financial services, they tend to be those that help people make the most of their long-term money and help them live better lives. And that's where we're playing, and that's the long game that I believe positions us best.
Would you feel comfortable if there were a slowdown in the funding environment?
It's possible that it would play to our benefit. I do believe there will be some consolidation in a downturn. Naturally, there always is, and I think that it would at least help to address the question of what happens to X in a downturn. I think we'd see a lot of that and learn a lot from it.
All right, I want to ask you one final question, which maybe some of the other fintech entrepreneurs out there can draw some insight from. As you think about the way that customer acquisition works for Betterment, are there specific strategies or channels that you find to be either more impactful or more cost effective than others?
Over time, those have evolved, and every year we're testing in new channels. When podcasts were a new thing 4 years ago, we found that to be an incredibly efficient way for us to get the word out, and we were sponsoring Planet Money and things like that. And then that channel got fully valued, and I think it's less compelling, the economics there today. But there are other things that we're innovating in and always testing and learning.
Excellent. Well, Jon, I feel like anyone listening to this podcast knows where they can find you. But as a refresher, where can people go to learn more about this proposition and sign up with Betterment if they're interested?
Come to betterment.com. We would love to show you what customer-centric financial services feels like.
Excellent. Well, Jon, love everything that you and the team are doing. Wish you all the best. Thank you very much for joining us today.
Thanks, Will. Always a pleasure.
Thanks for tuning into Rebank. If you like today's show, reach out. Follow us on Twitter at Rebank Podcast and join the conversation. For more on banking, fintech, and the future, check out our regular content at www.bankingthefuture.com.